The topic for today is why do banks pay you to keep your money there?
Yeah, why do banks do that? I thought bankers are supposed to be selfish and evil.
I wouldn't go that far, but your bankers are neither philanthropists who give money from their own pockets to people in need, nor are they generous gods who can simply conjure money up from thin air. So, how do they make the extra money that they give you? The answer lies in fractional reserve banking. Any guess as to what this is?
Please repeat the question.
Any idea what fractional reserve banking is?
Well, reserve sounds like reservation, which is when you book something ahead of time. Is fractional reserve banking when you schedule a meeting with your banker in advance?
You are just a little off. Fractional reserve banking is the banking system that all countries follow today. When you give your money to the bank, called a deposit, the bank doesn't just leave it all in a vault. Instead, it lends most of your deposit to people or firms who need money right now, and only keeps a fraction of your deposit as bank reserves, hence the name. What would happen without fractional reserve banking? Let's think of a situation. Suppose there are 10 retirees who each have $50,000 in savings. There is also a bank, which wants to make money, a Javon, who is an ambitious recent graduate who wants to buy a house, and a rich person who has a $500,000 home he wants to sell so that he can go live in the Bahamas. Javon cannot buy the house from the rich guy because he only has $50,000 in his bank account and the house costs $500,000.
Right now, everyone is sad. The 10 people have money just sitting there and losing value due to inflation. The bank is sad because they cannot make money. The rich guy cannot move to the Bahamas. Javan is sad because he lives in a hammock. And Javan's coworkers are sad because every time he comes to work, Javan stinks.
Hey, I don't smell that bad. Maybe a little. Not to worry. Fractional reserve banking provides a solution. The bank collects $500,000 from the depositors and promises to pay them back 1% every year. Then they give Javon a $450,000 loan, and he promises to pay them back 5% every year over the next 20 years. The payments that the bank and the retirees receive as compensation for lending money are called interest payments.
Now everyone is happy. Javan gets to buy the house. The rich guy gets to live in the Bahamas. The 10 retirees and the bank get more money. And Javan's coworkers no longer have to douse Javan with a fire hose every time he comes into work. 1 second, what happens if everyone wants to withdraw their deposits at the same time? How will the bank ever be able to pay everyone back in that situation?
Excellent point. The previous example will only work if the 10 retirees never withdraw more than $50,000 total, or on average, $5,000 each. If they do, however, you are right. The bank will not be able to pay everyone back in full until they receive the pending loan payments from Javon. When banks are faced with a mass of people all wanting to withdraw funds at the same time, it is called a bank run. And they can be devastating, leading to banks collapsing and individuals losing their life savings. This is what happened during the Great Depression.
So you are saying it is safer to keep my money under my pillow than in a bank?
Fortunately, that is not the case. After the Great Depression, the US government created the Federal Deposit Insurance Corporation, or FDIC. Most banks are FDIC insured, which means that if the bank were to collapse, the FDIC will reimburse you up to $250,000 you have in qualified accounts at each institution. So if you had $250,000 at Bank of America and $150,000 at Chase Bank, and both of these banks were to collapse, the FDIC would reimburse you your full $400,000.
So unless I simply reek with excess cash, I do not need to worry about bank runs.
Correct, as long as your bank is FDIC insured, which most are. Also, FDIC insurance should cover checking and savings accounts, certificates of deposit, and money market deposit accounts, but will not cover any investment accounts you may have with your bank. So make sure to verify that your specific bank accounts are covered. So, what have you learned from this?
When you deposit money in the bank, you are effectively lending it to them. The bank then keeps a fraction of your deposit as bank reserves and lends out the rest. The bank makes money by charging an interest rate on the loans they give people. Thus, they can pay you a much lower interest rate to incentivize you to deposit your money with them. And until the wonderful day when I have more than $250,000 in any one of my bank accounts, I do not have to worry about losing my savings after a bank run. I just need to make sure that my bank is FDIC insured.
Congratulations! You've just learned the basics of how banks work.